Welcome to episode 3. What a week. So, we got some big updates. I'm going to jump right in. I don't want to waste too much time. So, this week was awesome. We got a few files cleared to close. If you're not familiar with the mortgage industry, clear to close are the magic words, CTC. Once we get a file cleared, that means we are eligible to close and get to the closing table so you get your keys. So that has been good this week. We got a few files cleared to close. Hit speed bumps on a few files, nothing too major, appraisal things, things that come up. There's really no telling when that will happen, especially in a market like this. The issue with this market is that the home buying activity is really low. So appraisers know that values will probably not pick up as rates continue to increase. So they're going to stay stable. And with that, sales have also slowed down. So there's not as many comps in most areas. So properties that had higher appraisals before in the last year or two now might start to come in a little bit lower just for appraisers being conservative, knowing that rates are where they are and will likely continue to increase. They want to be a little bit more conservative with the values that they give these properties. So that's normal. It's to be expected. Minor speed bumps, qualifying concerns, things that come up during the process. We're able to work through all of them. We're waiting on one update for an appraisal on one of our files, but for the most part, everything is moving along quickly and efficiently. We also onboarded 2 new team members, so new hybrids, new agents that are now duly licensed as loan officers as well. Congrats to them. We're excited to bring them on board and get them started on being a one-stop shop for their clients. So great update there. Now, there have been a lot of updates in the mortgage industry itself with guidelines and things that are going to make home ownership and the home buying dream possible for way more people. I want to go through some of those. We'll go through the threads as always and mortgage tips, and then we'll wrap up towards the end. So the beginning is going to be a little bit mortgage heavy. We'll go over some mindset stuff. I might bounce around with some of these threads and we'll see what actually makes sense to discuss. Otherwise, you can just go check those out and we can have a conversation on threads. So the biggest thing this week that has come about from Fannie Mae with a change to the guidelines on November 18th, conventional down payments for 2-family homes drops from 15% minimum to 5% minimum. For 3 and 4 family homes, it drops from 25% to 5% minimum. Now, this is for primary residences, basically a home that you are going to live in. Before, for a 2-family conventional, you had to put down 15%, and for 3 and 4 units, you had to put down 25%. Now it's 5% across the board. So before, people would have to go FHA, do 3.5% down for 2, 3, 4 unit properties, have their down payment and closing costs, and be in a property and use the rental income to qualify. With this new program for conventional, you can go down to 5%. So it's definitely going to be competition for FHA. Now, there are some caveats to this change. Yes, you can do 5% down and buy a 2, 3, 4 unit property, which is awesome. But conventional does have its own guidelines pre-existing before this, different than FHA, that we have to consider specifically with regards to qualifying and rental income. So for conventional guidelines, you cannot be a first-time home buyer, i.e. live with mom and dad, be buying your own primary residence, 2, 3, 4 units, go conventional, and use the rental income from that property to qualify. You have to be able to afford that mortgage payment for that 2, 3, 4 unit property on your own with your own income. You have no landlord experience. You have no property management experience. You don't have a housing payment currently. You live with mom and dad. And there's different levels to this. I don't want to go into too much detail because it could be a little overwhelming as far as information. But there are different scenarios where we can and cannot use rental income now. If you owned rental property before, have been a landlord before, have property management experience, have a housing expense where you're either have a mortgage or a rent payment, then you can use rental income from those properties. Basically, Fannie Mae, the government is trying to make sure that people have an ability to repay the mortgage and don't want people to rely on tenant income, because we know that sometimes tenants don't pay. So, off the bat, we're only allowed to use 75% of the potential rental income anyway. So, when we get an appraisal done on a multifamily property, we get the appraisal of the value. And this is also why multifamily appraisals are typically a little bit more expensive. The appraiser does the appraisal of the value of the property, and they also do an appraisal of the market rents for the property. So when we get that appraisal back, we know how much it's worth and how much the market rents are, and we're allowed to use 75% of the market rents if we're allowed to use rental income. So let's use FHA for an easy example. FHA, you could do 3.5% down for multifamily homes, 2, 3, 4 units. You only have to worry about your down payment, your closing costs. You don't need any additional reserves, which we'll go over next. And you can use 75% of the potential rental income from the other units. Conventional, same idea, sort of. Now, as of November 18th, when that comes, about a month and a half away, you'll be able to use 5% down on 2, 3, and 4 unit properties, have your down payment and your closing costs. You will most likely need reserves because conventional multifamilies do require reserves. And I'll go over what reserves are in our mortgage tip of the day. And also, depending on your experience, your current living situation, and property management or landlord experience, you may or may not be able to use rental income from the other units to qualify. Now, if you're a first-time home buyer, you most likely won't be able to use that rental income to help you qualify. If you have a current housing expense, you own a property, you may be able to use rental income to offset your mortgage payment, but not above and beyond that. And if you have rental landlord experience, have your own current primary residence or housing expense, then you can use all of the 75% of the rental income, covering the mortgage payment and even above and beyond that. So there's levels to this, and we can go over that. Huge change, definitely going to make impact in the market, because now a multifamily home listing agent and seller can get pre-approvals with FHA 3.5% down, which is probably most of what they get in the current arrangement, either FHA 3.5% down, or they might get some investor conventional pre-approvals where they have 25, 30% down, or cash. Now it's going to be FHA 3.5% down, 5% conventional down payment, and then investors with cash and things like that. So it's going to add another pre-approval, another buyer, another scenario to the mix, and it could help out a lot of our buyers as well. So if we've pre-approved you, or if you have a pre-approval as an FHA 3.5% down multifamily buyer, talk to your loan officer, talk to us, and see if we can change it to conventional 5% down, again, as of November 18th. Conventional loan limits are increasing again. So this is huge news. When conventional conforming loan limits increase, what that means is we're getting more wiggle room in loan amounts to get conforming interest rates and conforming loan terms. So, and again, reading from the note here, the thread, single family conforming loan limits are expected to go to $750,000. From 2006 to 2016, it held steady at only $417,000. So in 6 years, the conforming loan limit jumped over $300,000. So let me explain. So back when I started in 2013, the conforming loan limit was $417,000. It was like that from 2006 to 2016. That meant if your loan amount came in at $418,000 or higher, you were in either a jumbo loan territory, or in some cases, depending on where you live and where you're buying, a high balance loan territory. So what's the difference? So conforming loan limits, conforming programs have typically the most competitive interest rates, low down payments, 3%, 5% down for first-time home buyers on primary residences, and better terms overall. As soon as you go over the conforming loan limit, you're in high balance jumbo territory. The down payment requirements increase to 10 to 20% down. The interest rates usually get a little bit higher because the bank is giving up more money. They're giving a bigger loan. So if they're going to give up more money, that's less loans they can make. So they're going to charge a little bit more for it. They want a little bit more skin in the game from the buyer, right? Hey, we're going to give you $600,000. That's above the conforming loan limit. It's a lot of money for us to give to one borrower. We need you to put down 10%. We need your credit score to be a little bit higher. We need you to have additional reserves on top of that. So over the years, as prices in the market have increased, the loan limit minimum has also increased as well. Or maximum loan limit has increased as well. So it went from 417 to now it's going to be around 750. So what that means is, as property values are increasing, a house before that was 450 with 3%, 5% down, you'd be okay with staying under the conforming loan limit and getting the best terms. Then it went up a little bit. So as it goes up, now you can buy a house, let's say maybe around 800,000 with 5% down, maybe a little less, maybe 790 with 5% down, 775 with 5% down, something like that, and still be within the conforming loan limits, so that you get the low down payment, the better interest rates, and stay within the conforming limits where you potentially don't need additional reserves. So it's definitely going to be a huge game changer. Again, the increase that we've seen in the last 6 years is because home values have increased, supply has tightened, right? There's not a lot of inventory on the market. It's keeping prices high. People are falling into high balance or jumbo territory and having to come up with 10% down, 15, 20% down. Now they're going to increase that again. So it's going to be a little bit more affordable for people. So all of this is a result of what's going on in the industry and the government trying to stimulate the real estate and mortgage market a little bit. And it's going to help our buyers and sellers who are looking to sell and buy again qualify and obtain real estate. So all good things there. A little bit more in regards to the economy. So this week's unemployment report expected was 210,000. The actual came in at 207,000. So if you saw last week or listened to last week's episode, you heard the numbers for last week. They drop this report every Thursday, the jobless claim report, they call it. So same thing, unemployment rate, unemployment report. It was expected at 210. It came in at 207, still lower than expected, similar to last week, which means the Fed is expected to keep rates higher for longer. So again, the Fed is hell-bent on decreasing inflation because inflation is tied to the power of our dollar. So we don't want our dollar to become so weak that it's not valuable. That's when things can get really bad. So they want to decrease inflation. They want to keep the power of the dollar at a certain level. And in order to do that, they have to stop people from spending and attaining so much easy money. And this all comes from the pandemic and the stimulus checks that were sent out and all the money that was printed, right? You put more money into the system, every dollar just becomes weaker by design. So what they want to do is use the reports, use the economy to determine what they're going to do with interest rates. By increasing interest rates, it decreases market activity, it decreases spending, it decreases people borrowing to then go and spend money. So it'll decrease inflation and slow the economy down. Now, jobless claims and unemployment are one of those factors. If people are losing their jobs, then obviously they're not spending. And if they're not spending, then inflation comes down. But when they see unemployment reports that are coming in lower than expected, meaning the job market is still healthy and strong, they say, hey, you know what? We need to keep these rates a little bit higher or maybe even raise them a little bit more so we can get this spending down. So that's where we're at this week. We'll see what happens next week and every week as we go through these reports and obviously our podcast. Okay, so let's get into some mindset stuff here. So the number one phrase people who are good at small talk always use, says a Stanford public speaking expert, is tell me more. So if you work this into your conversations, especially the dreaded small talk, you'll do a little bit better and have a little bit more comfort and something to fall back on when you're in these environments. So for me, I hate small talk. I don't know if you guys are the same. Small talk, maybe it's the introvert in me, maybe it's the Virgo in me. I don't know, but I don't like having small talk. I avoid it if I can, just because it's meaningless and there's nothing really that comes from it. It can be kind of awkward, right? So I've had to implement things to help me with navigating that and not being so intimidated by small talk. And I saw this report and thought it was a pretty good tip. I've had it in my own way. Again, we spoke about this on different podcasts where networking is really about listening. And what you can do is get people talking. So all you're really doing is asking questions, getting to know them with genuine curiosity, right? Like about what they do, their business, their hobbies, right? Personal questions. And then you can find common ground so that you can build rapport with people. And I thought this report was pretty cool because Tell Me More is a great tool to fall back on. It's simple, it's easily remembered. So if you're in a small talk situation, or especially in a networking situation, right? Small talk is one thing. You're in an elevator, you're in the lobby, you're online somewhere, for a service or lunch, or you're just moving around in the world like we do. You might bump into people, acquaintances, neighbors, and have some small talk, and that's okay. Some people do dread it and hide from it, but it's gonna happen. So a simple, I know up here in the Northeast, it's a thing where we say, oh, how you doing, how's it going, but we don't really care about the answer, right? We're not really asking to start the conversation. It's kind of in passing. I don't know if they do that everywhere, but I've seen over the years memes and things of just a North Jersey, New York, East Coast kind of thing. How you doing? And keeping it moving. So I don't know if that's true, but with small talk and bumping into people, you kind of have these conversations. But when you're in a networking event or environment and small talk is a requirement of being there, it's inevitable, it's definitely going to happen. Having this thing in your back pocket to kind of fall back on is awesome. So you're in conversation with somebody, you strike up the conversation or they strike up the conversation. If you're using the hacks that I gave in my earlier podcast, then the conversation has already started, whether you initiated it or not. And then you get to a point where maybe there's a lull in the conversation or you're not sure where to go next. Tell me more. Tell me more about your family. Tell me more about your business. Oh, you had this experience in running a podcast or social media. Tell me more about that. Just something where they can say, well, and just give you more detail and kind of keep going into it while you're digesting their information and taking it in, and really, again, have that genuine curiosity so that you can continue that conversation, continue to learn and find common ground. The whole point of networking and building rapport is finding common ground, something where you can relate to this person and have something to fall back on or something to build upon and build that relationship. So you're trying to find that. And I think Tell Me More is a great little tool, great little tip. So look that up. It was on CNBC from a Stanford public speaking expert using the phrase Tell Me More. Okay, let's scroll down, see what else we got. I'm going to skip that one. I'll say it. We don't have to dive in. It's kind of self-explanatory. It used to be that you couldn't leave the house without spending $100. Now you don't even have to leave the house. I posted that this week just because I literally didn't leave the house and spent over $100. I don't know what I was doing. Food, Amazon, just things that I needed. And it's like, wow, I didn't even leave the house and the money just, leaves. So something there. Okay. This was I had this conversation with a couple different people. Pretty interesting question here. One client referred me 4 people the day after he closed on his mortgage. Another client closed 4 mortgages with me over a few years and never referred anyone. Which would you prefer? I'm going to read it again. One client referred me 4 people the day after he closed on his first mortgage. So he closed, said, hey, here's 4 names and numbers. I already told them about you. They're interested in getting started. Another client closed 4 mortgages with me over a few years and never referred anyone. So this client loves me, loves what I do. We have a thing. They bought their primary residence, bought a couple investment properties, and just never referred anyone to me. And there's no hard feelings. It's awesome. I want to be their go-to person. They just haven't said, hey, here's someone else, here's someone else, here's someone else. So which would you prefer if you're running a business? So I spoke to a couple people about this. And it's kind of a trick question because the answer is you want a person that does both, right? We call them raving fans. If you're in sales or in business, the book Raving Fans is something that I suggest to all my team members, especially newer people in the business, whether they're new to real estate or new to mortgages or just sales in general. Raving fans. You want to create raving fans. So that's the answer. The answer is I want a raving fan. I want someone who's going to use my services every time they're in the purchasing, refinancing, selling process. And I want them to refer me to their friends and family every time, whether it's when they close or just throughout the just throughout our relationship, throughout life. And I actually have people that have never closed with me for other reasons. They're just not there yet, don't own property, that refer me everybody they come into contact with, but they haven't closed anything with me. So what would you prefer? If you're building a business, I guess the obvious or short-term answer might be, oh, I want the person that closes 4 times with me. Every time they do a deal, they come to me, because that's actually dollars in the bank. And that makes sense, especially in the beginning. I know in the beginning, when I was starting in this business, I wanted the people that would close. I wanted commissions. I wanted checks, right? That's what we're here for. As I grew in the business and started to have a long-term view, I want to build my network and my database. So names and numbers and referrals are golden, because you don't know where they're going to go. One of those people could be the person that closes 4 mortgages with you in 5 years, or 10 mortgages with you in 20 years. And you don't know until you get that referral. And also, it's not limited to just 4 or 3 or 2 referrals. Some person can give you 10 over a month, or 10 over a year, or 20 over a couple of years, right? So that's what we want. We want the long-term network building. Introduce me to more people, more names, more numbers, because if they're not ready now, they will be at some point. And there's only so many loans and mortgages and purchases and properties one person is going to close. Typically, it's 3 to 5 real estate transactions in the course of a life. So figure on the low end 3. You rent your first place when you move out of mom and dad's. You buy your starter home. You get married, have a family, start having babies. Maybe you upgrade to another property, and then you retire, sell that, and downgrade to a condo or somewhere down in Florida, right? Who knows? So let's say 3 actual purchase sale transactions in a lifetime. So in our business, there's not a lot of repetitive buying and clients, because it's such a big financial ontaking and just such a big financial, or not even financial, just such a big milestone in life that people don't do it every day, right? We're not selling, $5 coffees or something where you can have a client come in every day and spend with you. We're doing it once every decade, where you're having an interaction and a transaction. So would I want that person? Yes, of course. I want to be your go-to. I want to be just like your CPA, your financial advisor. I want to be involved in the process. I don't plan on leaving this business. Even if I'm not doing the loans per se, I have my team handling things. I still want to be the person that you come to for all those transactions. But at the same time, I'm looking to build this database, this book of business, and this network. So I really want you to experience the process, fall in love with it, accomplish something, reach your goal, and then send me everyone that's talking to you about buying real estate. That's the goal. So it's a trick question. The answer is a combination of both. Also, if you don't own a house or don't plan on buying property, I know people who are very successful, make a lot of money, and don't own a house. They rent. Nothing wrong with that. Renting is a part of living. Renting is a part. There's a space for renters. There's a space for owners. There's times where it makes sense to rent. There's times where it makes sense to own. Not everything is for everybody. Those people that rent, they do really well. They still refer me people that are buying, friends, family, children, nieces, nephews, parents. I'll take that too, because the power of the referral is so strong, because it just can bring so much. It's unknown in the moment, but it can bring so many more referrals, so many more relationships that can build a business. So that's the trick of the question, is that it's really a combination of both. We want raving fans, people that use us for every transaction, people that refer us to all their people, refer all their people to us. And even if they're not using us per se, because they're not an owner and don't plan on being an owner, they're still referring people to us to use our services. So that one is something to ponder. Definitely reply back to that on the thread. Let me know what you think, and we can have a conversation about it. What separates the rookies from the vets? The vets can use their experience to anticipate what's needed next. Rookies don't have that wisdom and typically just react. Anticipate, then be proactive, and you'll shine. I have a lot of new team members coming on board and over the years that I've helped, and the main difference between someone that's new and someone that's experienced is their ability to anticipate and be proactive in a process. And with experience comes anticipation. Even think of athletes. The best athletes can anticipate and be proactive in whatever the scenario is because they've seen it, been through it, you know, they know it. They have that instinct because they've experienced it. And rookies just don't have that yet. They're new. They might not be new to the game per se, whether you're an athlete, business, whatever it is. You might not be new to the game, but you're new to the league you're in. You're new to the speed of this game. You may be new to the terms of engagement, the terms of the business. So you're learning as you go and you don't have anything to fall back on. So the biggest thing that leaders need to do for rookies is shine the light on how things can go so that you can anticipate what could potentially go wrong. And how you give people a great experience or how you perform at the highest level is anticipation. And I think that's something that we don't talk about enough as far as leaders and training new team members. We might tell them how to do things. We might tell them technical skills. We might tell them, in my case, how to talk to a client, how to get an application, how to lock an interest rate, how to get a file to the closing table. But teaching them really how to anticipate what could potentially go wrong or anticipate what could potentially be requested is maybe more important. Anticipating what a potential client could say, objections, rebuttals, things like that we have because we have the experience that we need to share with these team members to give them the most ammo possible and the biggest chance to be successful and have the tools they need to be successful in any industry, in any game, in any league, right? Whatever you're doing, that anticipation is really what makes or what separates the pros from the minors, or the vets from the rookies, or the successful from the unsuccessful, because your ability to see what's coming, have the vision to see what's coming before it happens, is priceless. You want a samurai sword, Hattori Hanzo blade? Those only come from the hottest flames. Find me a master swordsmith without some serious burns. Michael Prince from Billions. So I don't know if you guys watch Billions. I like Billions. Obviously, it's finance related. It's up here in the Northeast. It's in New York, Wall Street, hedge funds, numbers, money, big money, right? Billions. Just a good show. And that was something that was said. We don't have to dive into it too much. Again, I think it's self-explanatory, but it's something that I just shared. You want a samurai sword, Hattori Hanzo blade, which are the best of the best. Those only come from the hottest flames, right? There's something there with just success in business and mindset. If you want to achieve greatness or go through something, you think it's going to be easy to get something of value. That's usually never the case. It's usually really difficult. If it was easy, everyone would do it, right? All these things. The best samurai swords come from the hottest flames. You got to go through it and you'll be stronger for it. So just something there that I thought was interesting to thread. He said, find me a master swordsmith without some serious burns, which basically means the person's so good at what they're doing, they're working with the hottest flames and they got no burns on them. It's like, wow, they must be really good. So that's just a analogy or metaphor for whatever you're doing in your life or whatever goals you have, you want to accomplish, to look at it from that perspective. Studies show charisma is a balance of warmth and competence. This is from Vanessa Van Edwards. If you are very competent, you might find yourself struggling to get ahead. Practice increasing your warmth. If you are very warm and find yourself struggling, practice increasing your competence. Strike the balance. So charisma is something that just oozes from your pores, right? It just comes out of you. And some people have it and some people don't. And the formula for it is competence and warmth. So it's knowing what you're talking about and doing it warmly and making people feel good about you. So if you're struggling with getting ahead, it could be because you're overcompetent and not warm enough, right? We've all dealt with these people that are super smart, super technical, know all the facts, but they're cold. There's no warmth. There's no teaching aspect. There's no helping aspect. There's no education aspect. It's just competence, 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 almost like a robot. Nobody likes that. On the other end, if you're very warm and find that you're struggling, practice increasing your competence, right? So there's people that we know and love, and their energy's high, they're super warm, big hugs when they see you, big smiles, always a good time, but their competence is lacking in whatever they're trying to pitch, sell, teach. The competence is not there. It's almost too warm where it comes off fake, and you don't want to give them a chance at what they're talking about or trying to get you to understand. You got to strike the balance. So that charisma, that je ne sais quoi, right? That, well, there's just something about this person. They have that thing that's charisma. It's a balance, not a combination, a healthy balance of competence and warmth. So just something to work on. I know I have to work on it. I can be very competent about some things and not very warm. I can be very warm and not input my 2 cents where I have the competence and maybe not get ahead in that sense. So it's just something to keep in mind with striking that balance of competence and warmth to make sure you get ahead. So that's the threads for this week. Some awesome topics there. I am glad to go through those and touch on some of those things. And we're not going to go through every thread every week, just things that I think make sense to dive into a little bit deeper. We're going to go over a mortgage tip or term now. So I mentioned earlier in the podcast reserves. So this came up a couple different times, which is why it's something that I want to discuss on the podcast. So a lot of guidelines when it comes to mortgages and mortgage programs will require reserves. Now, what are reserves? So reserves are money in the bank on top of down payment money and closing costs. So when we look at a bank statement and we're trying to qualify someone, for some programs you don't need reserves. FHA purchase, single family home, first time home buyer, you don't need reserves. You can have just enough for the down payment, the closing costs, and get approved and close. For some properties and some programs and some scenarios, you need reserves. For example, conventional multifamily purchase, you're going to need some reserves. Any non-QM or creative financing, DSCR, investor cash flow, bank statement only loans, you're going to need reserves. And reserves are peace of mind for the lender. So if they're giving you any type of risky loan where there's any level of risk beyond standard, beyond low risk, they're going to require reserves. So they want to see that you have mortgage payments of the new property. So let's say the mortgage payment includes principal, interest, taxes, insurance, maybe HOA dues, flood insurance, anything like that. We call it PITI, P-I-T-I, principal, interest, taxes, insurance, and then A sometimes for association fees for condos and things like that. So the PITI payment. So they're going to want to see that you have 1 month, 3 months, 6 months, 9 months, 12 months, depending on your scenario and the risk involved of those mortgage payments above and beyond down payment and closing costs. Okay? So if you're purchasing a property and you don't own any of the property, but it's a multifamily property, conventionally, the underwriting guidelines could require you to have 3 months of reserves on top of down payment and closing costs. So if your mortgage payment total, PITI payment comes to $4,000 times 3, that's $12,000. You need your down payment, your closing costs, plus another $12,000 in your account at closing in order to get cleared to close. If they take your bank statement, you have $40,000, down payment and closing costs come to 30, and there's only 10 that's going to be left over for reserves, and you need 12, you need to put more money in the bank, you need gift funds, you need more money in order to get approved and close. That money is not liquidated. It's not money that's going to be taken out of the account. It just needs to sit there after closing, at closing, prior to closing, right? So they want to see it before in order to clear your file. At closing, you're going to cut a check for the rest of your down payment, closing costs, whatever's left. And then after closing, the money's still going to be there. We're not necessarily taking it out, but they do want to see it. That's what reserves are. Now, if you're getting any Non-QM loan. Non-QM means non-qualified mortgage. So bank statement only loans, asset qualifying loans, 1099 only loans, investor cash flow loans, or DSCR. DSCR stands for debt service coverage ratio, where they look at the rental income from an investment property versus the mortgage payment. That's it. If you're doing anything like that, they will want to see reserves. So you have to have the down payment, the closing costs. They won't look at any other documents, but they want to see that you have 9 months of reserves, 12 months of reserves. So again, if you have $4,000 in your mortgage payment, 12 months is an extra $48,000 in the bank they want to see for reserves. So it's definitely something that gets overlooked. Talk to your loan officer about it. Hey, do I need any reserves on this file, on this pre-approval? And make sure that they're clear about it, because you can run into issues. Again, going back to anticipating, being proactive, having experience, having the wisdom to coach your people through this process. You want to make sure your loan officer knows what they're talking about, and that nothing's going to pop up and say, hey, you need an extra 15 grand or $48,000 in order to clear this file and actually do this. And now you're already under contract. You gave a deposit. Your deposit could potentially be lost, right? You don't want to go through those things. So reserves are a factor of most pre-approvals, unless you're a first-time home buyer buying a single-family property in most cases. Missed opportunities. So a couple missed opportunities from last week. Nothing necessarily funny or witty, but some things I just want to clarify. So I mentioned using the down payment assistance program last week, and there are actually ways to pay $0 out of pocket. So my last example, that client came to the table with $1,800. I want to be clear that there's ways where you can come to the table with nothing out of pocket, right? If you get down payment assistance and you get a seller's concession that covers all the closing costs, well, then really there's nothing left for you to pay. You can come to the table, own a property with no money. Now, if you're doing that, your offer is a little less attractive to sellers and listing agents, right? Because you're not putting any skin in the game. You're not giving any down payment or closing costs or deposit yourself. So your offer may not get accepted as easily as someone who's putting the down payment and paying for the closing costs themselves, but it's doable. So I wanted to clear that up. Also, I said all 50 states for the down payment assistance program. The Chenoa fund itself is not available in New York, so I wanted to clear that up. If you're buying in New York State, Chenoa fund is not available, at least at this time. It may be in the future. We will keep you updated on that. I think that's it for this week's pod. Pretty simple, short and sweet. Thank you for your attention. Thank you for your views and your listens. Like, comment, subscribe, share, all that good stuff. And before we end, the goal in life is to be mortgage free. Control your emotions, have integrity. If you want to use my likeness, I need equity. And if you're really trying to win, you need to bet with me. Till next time, we'll talk soon.